All right, we need to talk about something big that's happening right now. A massive test of confidence is rocking a corner of the financial world that honestly most people have never even heard of, but it's become an absolute titan. We're talking about private credit. And when I say titan, I mean it. First, just get a look at this number. $2 trillion. And that's probably a conservative estimate for how big this market is. Think of it as this giant hidden engine room for the economy, lending money to thousands of companies, all happening away from the public stock market. And right now, that engine is seriously starting to choke. Because what was supposed to be this super steady, high return investment is suddenly facing what is, for all intents and purposes, a classic run on the bank. You've got investors all at once rushing for the exits, screaming, "Give me my money back," only to find out that the door is locked from the inside. And yeah, that brings us right to the heart of the problem, the great cash crunch. This is what it looks like when the promise of getting your money out easily crashes headfirst into the reality of assets that are incredibly difficult to sell. So, in the first quarter of 2026, this one, frankly terrifying, word started getting thrown around the industry: gating. Gating is just a fancy way of saying a fund is legally slamming the door shut, blocking or at least severely limiting investors from cashing out. And we are not talking about small-time shops here. We're talking about the biggest names in the game. Blackstone, BlackRock, Blue Owl, they all had to put up the gates. The poster child for this whole mess, though, quickly became Cliffwater's huge flagship fund. In a single quarter, investors tried to pull a staggering 13.9% of the fund's entire value. That isn't a trickle. That's a stampede for the exit. So what do you think happened when they all got there at the same time? Well, it wasn't pretty. You can see the problem right here. Investors asked for about $4.6 billion. What they actually got was half of that. For every dollar an investor wanted back, they basically got 50 cents. The rest, trapped in the fund, with no clear idea of when they'd ever see it again. And make no mistake, Cliffwater was not some isolated case. The problem was everywhere. BlackRock only managed to pay out about half of what people asked for. Blue Owl just flat out suspended redemptions entirely. Now you might see Blackstone there at 100% and think, oh, they're fine. But look at that little asterisk. They only managed that because the firm and its top executives had to personally inject $400 million just to stop the bleeding. That's not a long-term solution. So you have to be asking, why? Why did this all blow up at the exact same time? Well, it turns out it wasn't just one thing. It was a perfect storm of three separate problems that all hit at once and fueled this panic. Catalyst number one was a tech meltdown that traders started calling the SaaS apocalypse. See, these private credit funds had just poured billions and billions into software companies. It got to the point where a full quarter of the entire market was made up of loans to software and tech businesses. But then the explosion in AI suddenly made it look like a whole lot of that software could become obsolete almost overnight. And if the companies are worthless, what does that mean for the loans? Then came problem number two, fraud. Right as everyone was starting to panic about AI, a couple of big companies that had borrowed a ton of this private money collapsed. And they didn't just collapse. They did so amid accusations of massive fraud. That just shattered investor trust. Jamie Dimon from JP Morgan really nailed the mood with this quote: "When you see one cockroach, there are probably more." People started to wonder what else was lurking in the shadows. And the third problem was this quiet, slow rot from within. More and more companies weren't actually paying their interest with cash. Instead, they were paying their debt with more debt. It's a mechanism called payment in kind, or PIK. And look at this. The use of PIK has almost doubled since before the pandemic. That's a huge red flag that these borrowers are in serious financial trouble. So with trust completely broken, a fire that started in these private funds wasn't going to stay contained for long. It started to spill out, hitting the public stock market and, more worryingly, raising really serious questions about the entire banking system. The stock market's reaction was, to put it mildly, savage. The publicly traded companies that manage these giant funds just went into an absolute freefall. Blue Owl, which had to freeze withdrawals, saw its stock get hammered, down 70%. Ares Management down by a third. Even the mighty Blackstone took a 35% hit. Wall Street was sending a very, very clear message. But this is where the story gets really scary for everybody else. The banks. Why? Because it turns out that U.S. banks have lent almost $300 billion directly to these private credit funds. All of a sudden, a problem in this hidden market started to look like it could become everyone's problem. And this is how a terrifying feedback loop gets started. Just walk through this with me. Step 1, investors demand cash from the funds. Step 2, the funds, short on cash, turn to their banks and try to draw on their credit lines. But step 3, the banks are now getting nervous about the risk, so they start to pull back and tighten lending. This forces the funds, in step 4, to sell whatever they can at fire sale prices to raise cash. And what does that do? It makes investors even more panicked, which leads to more redemption requests, and the whole cycle starts over again, but worse. A crisis of confidence is how a crisis of solvency begins. So, how on earth did we get to this point? How did this shadow banking world get so huge and so tangled up with everything else? Well, to really get what's happening now, you have to understand the absolutely meteoric rise of private credit over the last 2 decades. This timeline really tells you the whole story. Back in 2000, it was a tiny $46 billion niche market. But then, after the 2008 financial crisis, new rules made banks pull way back on risky lending. Private credit just flooded in to fill that vacuum. Then you had a decade of 0% interest rates, which pushed huge investors into the market, desperate to find any kind of return. And finally, there was this big democratization push to bring in regular retail investors, and boom, here we are, with a $2 trillion pillar of the modern financial system. Which brings us to the big debate right now. Is this just a painful but maybe necessary reckoning for a market that got way too hot? Or is this the first tremor of the next big systemic financial crisis? Now, some people will compare this to what happened in 2022 at Blackstone's giant real estate fund, Bright, which also had to limit withdrawals. But today's situation is a whole different animal. The Bright issue was mostly contained to one manager in one specific asset class, real estate. This crisis is hitting multiple managers across the entire industry, it's deeply connected to the banking system, and it's facing this new structural threat from AI that simply wasn't a factor back then. The real alarmists, people like the famous investor Jeffrey Gundlach, see this as the first domino to fall. They look at the mix of hidden debt, hard-to-sell assets, and panicked retail investors, and they say, yep, this is the classic recipe for a much, much bigger meltdown. But on the other hand, you have cautious optimists like Howard Marks from Oaktree. They argue that the risk is actually contained. They'll point out that most of the money in private credit is in long-term funds that can't be pulled out on a whim, which limits the chance of a widespread fire sale. To them, this is a painful shakeout for sure, but it's not a threat to the whole system. When you boil it all down, though, this entire crisis really stems from one single fundamental conflict. The industry tried to take a product, a portfolio of private company loans that are fundamentally illiquid and hard to sell, and market it as a liquid investment where you could get your money back easily. For a long time, that illusion held up. But when everyone rushed for the door at the same time, the basic math just fell apart. And that leaves us with the central $2 trillion question at the heart of this whole drama. Was this promise of having it both ways, getting the high returns of private deals with the easy access of the public markets, was that ever actually possible? Or was it just a financial fantasy that was always eventually going to collide with reality?